Welcome to the Asset Preservation Hour. My name is Cynthia DeFazio, and I'm joined today by Stewart Willis. He is the president of Asset Preservation, Wealth, and Tax. And to our viewers at home, we're going to be covering how to create a real tax plan, Social Security taxes, and the 3 stages of retirement planning. But first of all, Stewart, how are you today?
I'm doing awesome. I'm enjoying life. Nice, cool weather here in the summer.
Very cool. A jacket required, right?
Yeah. It's crazy. This has been way too hot for me.
It has been very warm. I agree with you. And I know that you're obviously so extremely busy. Every time I see you, there's more growth. There's more things that are exciting that's happening. Let's talk about what that growth pattern looks like for you before we dive into the show. What's new?
You know what? I think the news on the home front is we're busier than ever. We opened up our brand new Scottsdale office on Scottsdale Road in Frank Lloyd Wright, right next to Capitol Grill in Maggiano. So as you can see, this button looks like it's getting a little stretched out here. I'm stressing it to the limit. I think Capitol Grill has been taking its toll on my waistline. But, I was just given a gift by our cameraman here, and this gift here, it's called Going Greek. I don't know if we can pan in on here, get a zoom on here, but this is a movie that I did out of college.
Oh my goodness!
I did this movie because I figured, hey, I'm gonna, my kids are gonna think I'm this old man that's not very cool, and I had a friend that during the .com boom, he invested in this company called Insight Pharmaceutical, and he basically made millions of dollars overnight as an engineer, funded this horrendous movie. And if you want to entertain yourself, do not watch that movie. It's terrible. But
you know that people are Googling this right now.
Good luck getting it. You can only get it on like physical DVD form. So pretty fun. Anyways, well, thank you, Greg. Appreciate you, man. Thank you for the great gift.
And thank you for sharing that with us. That's awesome. So I want to talk a little bit, Stewart. Obviously, people that have been watching the show for a very long time, they know that you are very passionate about tax planning. You focus very heavily on it. So I should ask you, now that tax season is over, what should people be thinking about with taxes? And are they thinking about taxes at all right now? What's going on overall?
You know what? I think that, people tend to make financial decisions when they have something we call triggering events, right? When there's a reason to do something, right? Life changes, spouse passes away, they inherit money, whatever. And look, those are important times to make decisions. I think in the middle of the year, people just kind of forget about the stuff, right? They let it go away. And I just think that, our biggest show every year is when we talk about New Year's resolutions. I mean, just the phones ring off the hook. People want help. It's the same reason why the gym parking lots are full. I can't find any, any places. Now, look, it's been a few weeks, as you can tell from this waistline here. It's been a while since I've been in the gym here. But I think it's important financially not to lose sight of it, right? And I think that when it comes to your financial plan, I think people become like an ostrich, where they bury their head in the sand, they assume that everything will just be fine. But look, if you do that, you're going to get ran over. It's like a boxer that, if a boxer just closes his eyes and just starts swinging, well, he's going to get knocked out. You got to look your opponent in the eye, have a plan, and move forward. And I think it's important to now have summer resolutions or post-summer resolutions, to keep you motivated to keep thinking about taxes as an important part of your financial plan.
Sure. And Stewart, I should also ask you, obviously, there's a difference between taxable income and adjusted gross income. Can you take some time and differentiate the both, please?
Yeah, I always tell people to focus on taxable income. And quite honestly, a lot of them are looking at adjusted gross income. Now, what taxable income is it's your adjusted gross income minus your deductions. So they look at either your standard deductions or your itemized deductions, and that's subtracted off. Well, your taxable income is what determines your brackets, right? So it's a really important number, especially when it comes time to tax planning. Adjusted gross income and modified adjusted gross income are still really important, especially when it comes to benefits like your Medicare penalties and IRMAA and all of these other sort of things. So they're not numbers that I want to discount, but from a tax planning perspective, we really want to focus on taxable income.
Okay. And specifically, Stewart, what did you learn during tax season? Let's talk about that a little bit.
Well, I did learn that I couldn't get my work done in a normal 40-hour work week in 5 days. I'm trying to become a man of leisure, but at the end of the day, no, look, I think tax season, it's a lot of work. It's a tremendous amount of hours we put in. But what I learned is that, you know, for the first decade of my career, I was faking it. You know, we have way better information by having tax planning, right? It really, this tax office gives us such better information when it comes to, you know, creating a plan. But what I noticed a lot is that the biggest surprise is that, you know, when we're going through taxes, newly filed, you know, retirees or newly retired tax filers, to be more clear, just are surprised when it comes to the Social Security tax. You know, people never expect to have to deal with that.
Sure.
And they don't plan for it, and they end up owing a ton of money, not calculating that properly, especially for the newer clients that are coming in.
That sounds scary, but I have to ask you, universally, are people happy when they get their tax returns back?
Well, here's the thing. At the end of the day, I could be an absolute hero with these clients if I just over withhold on their distributions, right? Like if I want to be a hero every tax year, I can just withhold 35% out of their IRA distributions or whatever. But that's not always the right move. You know, you don't necessarily want the government as your savings account. But you also, you know, personally, I don't want to get yelled at every year when people owe taxes. So I think there's a happy medium if I want to live that, you know, life of leisure here. But no, I think that it's important that people understand where we stand tax-wise, right? You know, where people are unhappy, to be honest, is when we do tax planning and we do things like Roth conversions, and they end up owing a ton of money for taxes. You know, look, we explain it, but you always get a bit of that sticker shock because remember, a Roth conversion isn't free. You have to pay the tax bill on it.
Sure.
You know, and I would just say this, that we are in one of the most efficient tax windows in history right now. You know, the slide I use over and over and over again, this graphic here, it's showing you the tax brackets here overlaid with the current tax brackets overlaid with the previous tax brackets. So we are in this red zone right now. And, you know, the way I look at taxes is going from 10% to 12% is a small jump. 12 to 22 is a huge jump. 22 to 24 is a small jump. 24 to 32 is a huge jump. But what I really want to show you on this graphic here is look at the difference down there between the blue and the red, right? There's that whole range, especially, you know, in that 12% bracket, but also the 22 to 32% bracket. Taxes were a lot higher before. Yes. And guess what? Taxes, if Congress doesn't act, we're reverting back to the old higher tax rates at the end of 2025. So technically we have 3 years. Right? We have 23, 24, 25 under the current law. People are going to look back and say, I wish I would have taken advantage of this time right now. Very important. I know it's the same message I say all the time, but it's really important to take advantage of where we are.
Sure, absolutely. And Stewart, really quickly, were you able to do a lot of tax planning when you were in tax season before we opened the phones?
Oh, look, here's the thing. I think that most people's idea of tax planning is when they go file their taxes every year in tax season. No, it's completely different. You never want to do your tax planning during tax season. These, God bless them, these CPAs, these enrolled agents, they're working their tails off. They're just trying to get through all their tax returns before April 15th. These people are working these long hours, right? You want people that are fresh when it comes to planning. Let them prepare your returns. Save it for now. After tax season's over, look, we're in the summer, they vacation, they went and visited, you know, all their family, now they're fresh, right? Now is the time to start doing real tax planning. And if you're concerned that your financial advisor doesn't consider tax planning inside your retirement plan, maybe you're missing out, because I think you are. If you don't take advantage of the next 3 years, one of the most efficient windows in history, you're going to look back and say, I wish I would have acted. I wish I would have done this. And if you want to make sure that your financial advisor is considering taxes, we're offering you a complimentary portfolio review. We'll take a look at what kinds of risks you're taking, what kind of fees you're paying, but also what kind of tax opportunities exist inside your portfolio. Maybe a Roth conversion makes sense for you. Maybe it doesn't. But we'll give you that honest second opinion. But you have to take action. Give us a call at 833-602-PLAN. That's 833-602-7526. Or even easier, if you click on that QR code, it'll take you to assetpreservation.com. That's our website. You have to take action, but we'd be glad to help.
Stuart, thank you so much. To our viewers at home, that number to call is on your screen, 833-602-7526, 833-602-PLAN. We're going to take a very short commercial break here on the Asset Preservation Hour. Don't go anywhere. When we come back, we're going to talk a little bit more in depth about taxes on Social Security and some moves that you can take that may reduce that tax liability. Stay tuned.
You've got quite an extensive resume. Wow, so many years of management. Bet that was fun. So this job requires basic knowledge of the social media and video platforms, content creation, and SEO. How proficient are you in those areas?
Going back to work after retiring is not ideal. I'm Stewart Willis with Asset Preservation Wealth and Tax. If you have amassed a nest egg, it's time for a financial advisor to help you reach your retirement goals. We are in one of the greatest tax windows in history, so it makes sense to take advantage of this tax discount while you can with your partners in retirement. All of our expert advisors, CPAs, and enrolled agents are fiduciaries that specialize in retirement planning, tax mitigation, estate planning, and more. Plan your retirement right. Call right now for your own complimentary portfolio review and tax analysis.
Welcome back to the Asset Preservation Hour. My name is Cynthia DeFazio, and I'm joined today by Stewart Willis of Asset Preservation Wealth and Tax. Stewart, a great show we're having today, a very timely show, speaking, of course, about taxes, but you mentioned something about people being surprised when they know that Social Security is being taxed. You have a lot of information and guidance to provide for this particular situation, which can be very quote-unquote taxing on people. So let's talk a little bit about that.
Yeah, absolutely. And look, I think Social Security is where people make tremendous mistakes and they don't even know it, because oftentimes they're listening to their friends at the water cooler, and their friends will say, hey, Social Security is going broke, so you need to take it as early as possible. But what if you retire and you need to go back to work? Remember, there's potential penalties on that if you exceed, very low income thresholds, right around $21,000, $22,000. If you make more than that in earned income, you could potentially pay huge penalties on tax. And, that commercial we just played, at break here is, a woman that retired and has to go back to work. You never want that to be you. When you're done, you want to know it's okay to be done forever. And oftentimes what happens is people end up retiring, they file for Social Security, and then they go back to work before full retirement age, and they get tons of penalties on Social Security. So they want to make sure they plan it out,
Okay.
And honestly, Cynthia, I think the other thing is people don't understand the sheer magnitude of how big Social Security is as a part of the retirement plan, because I think people take it for granted. And what we see all the time is people will come in with their $500,000, their $1 million, their $2 million in their retirement plans when they come to see us, and they want to plan. They're really focused on that. Well, what we're often seeing with couples is that oftentimes their benefit over their actuarial lifetime is between $1 million and $2.5 million. So why is everyone so focused on these investments, but nobody's thinking about Social Security?
Very interesting. And is it true that in 1983, up to 50% of Social Security became taxable? Is that the exact stat?
That's it. That's it. It is. And you know what? It's funny because politics are a real hot button. We're in this kind of purple state now. It used to be red, now it's kind of purple. And I mentioned a stat on one of our shows here, and I said in 1983, Ronald Reagan made Social Security taxable for the first time ever. He signed it into law. And, immediately I got calls from the, audience members saying, no, that was Bill Clinton. Well, Bill Clinton wasn't president in 1983, but guess what Bill Clinton did do? He made it more taxable. Up to 85% of your Social Security is taxable. So the reason, I'm concerned is that people don't really plan out their Social Security. It's a lot of money, and it's very important. Look, you were always told, since we're talking about taxes, that your income would be lower in retirement. And so why not defer your taxes during your working years to a time where you're making less and your taxes will be lower in retirement? Well, you may be making less, and your tax bracket may be lower. But what a lot of people never told you was that when you add your tax deferred income into your income stream and you're collecting Social Security, that taxable or that tax deferred income could be what's making that Social Security taxable. So do you want to pay taxes on that $1 million to $2.5 million of Social Security, or do you want it tax-free or tax efficient? Now, look, some people we can't, adjust whether they pay taxes or not on Social Security because their income's so high.
Yeah.
But I use this example. I have a dear friend of mine. He's a coach at a local high school that's, love Jacob to death. He's trained my kids, from a young age. A great man. But he has a 403B that, which is like a 401k for teachers.
Yeah.
And he's putting away all this money. The guy's got 3 or 4 kids that are all dependents. He's basically tax-free, right, because of all these kids that were dependents. Let me ask you this question. Why would you defer taxes at a time where you don't pay taxes? Does that make any sense?
No.
That's the point, is that these, once again, God bless these guys, these advisors that go into schools, they're telling the teachers, buy these 403Bs, do all this. And they're just creating tax time bombs for people that may not even pay taxes at all.
Yeah.
They're deferring taxes. Does that make any sense at all? You could take that money tax-free right now in some cases. Why wouldn't you just make it grow tax-free for the rest of your life? Why would you defer it till later?
Sure.
It's a big problem.
It most definitely is, Stewart. And obviously, we're talking about Social Security. We're talking about taxation on Social Security. But however, I've heard that the program is in jeopardy. And I think a lot of people watching the news would agree with that. So what advice do you have for those folks that are thinking about starting their benefits early?
Yeah, well, what I would say is this, is a lot of people that are saying, hey, I'm going to take my benefits early because I'm worried about it going bankrupt. That's the problem. Remember, what we're worried about isn't Social Security going away. It's basically, look, Congress is going to act. They're going to make sure Social Security is safe. But what they're going to do, in my opinion, is they are going to tax higher income folks more. They're going to get penalized more. And I said it on a previous show, what really scares me is when Lindsey Graham and Bernie Sanders agree on something. And what they agree on is that higher income folks don't need Social Security as much. To me, Cynthia, that's a dog whistle saying, hey, let's go ahead and tax the high income folks.
Absolutely.
Right? And so one of the ways that you can plan around that is by unloading a lot of that tax deferral now over the next 3 years while taxes are low and maybe you're not on Social Security yet, or even if you're on Social Security, take the hit for a few years, and then guess what? When all your money is tax-free in the form of a Roth conversion, it's very possible to have none of that taxed at all. Everybody's situation is different. I'm not going to give specific tax advice unless we meet with you. But look, here's what I'm saying. If you're concerned that you're just building up this crazy tax time bomb for later, when you may not even, be necessary to be paying taxes, maybe it's possible to be tax-free. If you're not considering planning in your portfolio, it's a problem. If your financial advisor doesn't talk about taxes or doesn't have a tax office to show you a cash flow analysis, you're missing out. So what we're offering to the audience today is a complimentary portfolio review and tax analysis at no cost. We can look at your tax returns. You bring in the returns. We'll show you, is there room for improvement? Is your portfolio taking too much risk? Are you deferring too many taxes? Maybe, maybe not. Everybody's situation is different. If you're curious, you need to take action. Give us a call at 833-602-7526. That's 833-602-PLAN. Or even easier, click on the QR code. It'll take you to assetpreservation.com. We'd be glad to help, but you have to take action.
Stewart, thank you so much. To our viewers at home, that number, 833-602-7526. We know that you have a lot of questions for Stewart about how to plan your perfect retirement. He has the answers for you. We're going to take a very short commercial break here on the Asset Preservation Hour. Don't go anywhere. When we come back, we're going to talk about the different stages of retirement and how your investment strategies may change during those years. Stay tuned.
We know the market is going to get worse from here. This is the biggest monthly decline in 10 years. People's 401ks took a major hit.
Well, my investments are tanking. My retirement isn't going as planned. I can't believe I let my kid talk me into buying crypto. I mean, what is that anyway?
This was the fourth worst contraction in history.
So how are you two doing?
Your financial future doesn't have to be uncertain. I'm Stewart Willis with Asset Preservation Wealth and Tax. If you have amassed a nest egg, it's time for a financial advisor to help you reach your retirement goals. We are in one of the greatest tax windows in history, so it makes sense to take advantage of this tax discount while you can with your partners in retirement. All of our expert advisors, CPAs, and enrolled agents are fiduciaries that specialize in retirement planning, tax mitigation, estate planning, and more. Plan your retirement right. Call right now for your own complimentary portfolio review and tax analysis.
Welcome back to the Asset Preservation Hour. My name is Cynthia DeFazio, and I'm joined today by Stewart Willis of Asset Preservation, Wealth and Tax. Stewart, such an important show today, obviously talking about taxes, Social Security. Now we're going to segue into the different phases of the retirement years, if you will, for people. My main question is, and this is a big one, what source of income should people be pulling from first in retirement?
Yeah, that's really the million-dollar question, and I think people get it, wrong quite a bit. And I think when it comes to determining your stages or where your sources of income are, you need to understand that there are three different main stages of retirement. The first one, of course, is your accumulation phase. Now, that's where, you're growing, you're still working, your money's growing, you're putting away. It's where you have no real concerns about risk, right? You're just growing, growing, growing. You should be full throttle inside the market. The next phase is the asset preservation phase. Now, that's where we come in. Where we come in is, 3, 4, 5 years before retirement or a few years into retirement, where you've said, hey, I need to take some risk off the table because I can't go back to work and earn it back if this thing loses half of its value, right?
Yeah.
You need to make sure you preserve it at this stage. And then we have the income stage or the income phase. Now that's when you just obviously start depending on an income stream in retirement. Now, I think that this decumulation or income stage here is really important because, the question now is, of course, where do I take it from, right? Where do I take my income from? And what we've seen is, everybody knows the basic principles of buy low, sell high. Everyone knows you're supposed to buy it low, sell high. And oftentimes they don't for a couple reasons, right? Number one, they get scared in the market and they sell. But number two, the other main reason is because, look, now they need income in retirement, and people that are in growth mode, if the market's down, they're taking income from an asset that's, dropped in value. That could be a problem. So as you near retirement or you go into retirement, we think that you need to have a certain portion of your assets that are fixed and safe and immune from all of the volatility of the market to make sure that you're not buying low or that you're not selling low and buying high. You want to make sure you have that very solid piece of your retirement puzzle that cannot go backwards.
All right, so let me just go ahead and recap for you, Stuart. We have the accumulation phase, asset preservation phase, and finally decumulation phase of retirement. I am seeing a lot of advertisements right now. A lot of people are talking about the interest rates going up, of course. So CDs, annuities, should we be looking at those right now?
Yeah, I mean, look, right now we have, short term, we have an inverted yield curve, which means that short-term rates are better than long-term rates. It's not going to last forever. And, by the time this thing airs for the second time, it'll probably be, alleviated. Who knows? But we're seeing fantastic rates right now. And people really need to take advantage of where we are. But I think the big mistake people are making is moving into such short-term investments. And the problem with that is those can change overnight. I had a client that, came to us and said, hey, with her short-term money in the bank, she said, okay, well, I'm looking at a CD and the bank is offering me 1 year at 5% or 10 years at 5.2. And this was right around 2017.
Okay.
And, logically you'd look at it and say, well, hey, why would I lock up my money for 10 years for 0.2% more, right? It's a problem in most people's minds. But what you have to look at is as interest rates fell, from 2017 on, when those CDs renew, you're renewing at lower and lower rates. So that 5% CD may have renewed at 3, and then 2, and then 1, and then 0.5%, right? Everyone knows we just were in the lowest interest rate environment in history.
Yeah.
And so people that were in checking accounts and money market accounts, they tend to forget about the fact that those accounts weren't making any money a year and a half ago. They were terrible.
Right.
Well, now they're seeing 4 or 5%. It's great. But here's the thing. If you don't lock in those rates, it's like refinancing in reverse, right? I mean, when you're in real estate, you're a real estate expert in Charlotte. And when people, have these houses, they had these higher interest rates on their mortgages, they refinance. People remember they were getting these 3%, 2.5%, jumbo rates.
Absolutely.
Which are crazy. Well, the opposite is true for fixed investments, meaning you need to refinance to these higher rates for the long term, right? So when interest rates were low, did you go buy an adjustable mortgage no, you locked in a 15-year or a 30-year fixed to know that you're gonna pay 2.5%, until it matures. Well, the investment world is the same way and opposite, right? Now that interest rates are high, you want to lock in these rates for a portion of your money. It doesn't make sense to do a CD, doesn't make sense to do annuities. Here's the thing. I think annuities are, I love them and hate them because look, locally here, we have, a group of advisors that advertises them on the radio, on TV. And remember, the misleading part about some of them is they say guaranteed 10% bonus or 7% income. Guess what? 7% sounds great, but income is what you take. Interest is what you make. What I care about right now is making sure that there's internal return, that the investments actually make some money. So don't just be handed back your own money over your lifetime. Make sure that you refinance those rates into higher interest rates that we're seeing right now. Lock them in for the long term and make sure that you can depend on that interest rate for years to come. If you're concerned that you need to refinance some of those old annuities that you have, or maybe you have some CDs that are maturing and you want a fixed portion of your portfolio that's making more return, we'd be glad to give you a second opinion on what the right direction is, but you have to take action. Give us a call at 833-602-7526. That's 833-602-PLAN. Or click on that QR code. It'll take you to assetpreservation.com. We'd be glad to help, but you have to take action.
Stewart, thank you so much. To our viewers at home, most specifically, thank you for spending time with us today on the Asset Preservation Hour with Stewart Willis. Any questions you have, please click on that QR code at the bottom corner of your screen. That will take you right to Asset Preservation Wealth and Tax landing page. Be safe, be happy, and be blessed. We'll see you back here 1 week from today. Take care now.